Last month, I had made a video on health insurance in 2025. Which one should you buy? What are the different criteria that you should look at and helping you shortlist it? The top comment on that video was from this handle called BBK Moto Love 221. The comment said that, can you also make a video on insurance for parents like age 60 or above? And so in today's video, I'm going to be doing exactly that. That comment, fun fact, got 44 likes. So there are a lot of you who want this video and hopefully you find this useful. Before we jump in, I'm going to set some context. One, I'm going to be covering a lot of the criteria we did in the last video, so some of you might find it repetitive, but for new viewers, it's important to understand on how we are shortlisting these policies. Two, I've assumed that the father's age is 62, the mother's age is 60. I've also assumed that you are not tied to this policy. This is a policy just for them. You should do that, by the way, because the policy is pegged to the age of the eldest member. And so you should have a separate policy. Your parents should have a separate policy. So coming back to that, the father's age is 62, the mother's age is 60. From a pre-existing disease standpoint, I have assumed that the father has recently gotten a cataract surgery done in both their eyes, and the mother has no pre-existing diseases. Fourth, from an area locality standpoint, I've assumed Delhi NCR because that's where I'm based. Current insurance policy that your parents have are none. I'm going to assume that they are covered under your corporate insurance plan, and this is the first policy that you're going to look into buy for them. And finally, the insurance amount that I've looked at is 1 crore. I'm also going to look at 50 lakhs because a lot of policies have 2x coverage from day one. So we look at 50 lakhs and 1 crore. With that, let's dive in. This channel is brought to you by the 01 Media Network by Zerodha. With their support, I'll be helping you spend your money wisely. Okay, so the first step is to identify what company to go with, right? There are 28 different insurance companies in India, health insurance companies in India. Our question is that which one should we shortlist for our parents, okay? So if you look at my screen here, this is IRDAI data over the last 3 years. This has all of the different companies that are listed here. Let's start with the first metric, which is 3-year claim settlement ratio. When you go on a Policy Bazaar or when you go on any of these respective company websites, what you will notice is that the claim settlement ratio there is a lot higher. That is because it's over a much smaller time frame. What I have tried to do here is I've looked at it over a 3-year period so that it gives you a slightly longer, slightly more stable claim settlement ratio, which is probably closer to reality. I am going to look at a claim settlement ratio of 95% and above. Claim settlement ratio's definition is claims settled over the total claims that the company received, averaged over the last 3 years. If you look at that, 95% above, there are these different companies. There are about 11 companies that have a 3-year claim settlement ratio of 95% plus. This has some public sector companies like New India Assurance and Oriental Insurance, some new age companies like Digit and Acko, and then your usual suspects like HDFC Ergo, Aditya Birla, and so on. Right, so that's the first metric. Second metric that we look at is incurred claim ratio. Incurred claim ratio is nothing but what it means is that if a company is getting 100 rupees in premiums, what percentage of those premiums is it giving out as claims? Now, if the incurred claim ratio is too high, say it's 120, 125, then the company can't afford to be giving out those premiums. And so that should ring alarm bells for you. That is this company overstretching itself, extending itself too much, and therefore can this be at a risk of going bust, right? But if it's too low, say it's at about 50s, then again, that's also not a good indicator because then this company is too opportunistic. They are not giving out the claims and they're rejecting too many claims, which is not a good thing. You've taken premium, you should also give out claims because your policyholders probably need it and that's why they're asking for those claims, right? So you want to strike a balance between this. I think somewhere the closer it is to 80, the better it is. With that, let's look at the policies here that we have. If you look at this, HDFC Ergo is at 86, SBI is at 81, all healthy numbers. Tata AIG is at 81. Aditya Birla slightly low at 68, but it's not too bad. So we will go deeper into this. Bajaj Allianz is 83, again really good. New India Assurance and Oriental Insurance are really high at 111 and 124. These are public sector companies. There is probably some taxpayers' money at play here. I would not be very confident about this. It doesn't make me feel very good, but I think this is not a very healthy sign if they are paying out so much more claim than the premium that they are receiving. Okay, so the third metric is average complaint rate that we look at to identify the company. Average complaint rates is nothing but what it means is that if there is 10,000 claims that a company has received, how many of those claimants have gone ahead and registered a complaint against the company? The industry average is 22. The lower this number, the better it is. Aditya Birla is bang at the industry average. If you look at the data here, it's at 22. Universal Sompo is close to the industry average of 21. The best performers in this metric are HDFC Ergo at 7, New India Assurance at 5. New India Assurance at 5 doesn't really surprise me too much, because if you're giving out so many claims, as we saw in the incurred claim ratio, why would people complain? But yeah, in the private sector, HDFC Ergo is doing really well. Bajaj Allianz is good at 8. So yeah, I think these are the two that stand out from an average complaint rate standpoint. What I'll do is I'm going to go through all of these different policies here in the next tab. So you have all of these 11 companies. We'll go through there in the next section, which is policy. So with that, we've identified the top 11 companies. Now let's go deeper into what are the different policies in this. Before we go there, I also want to call out two insurance companies that I'm not personally very confident about, which is Niva, Bupa and Care. As you can see, their claim settlement ratio is 91% and 90%, which is not very good. You could argue it's good, but it's not among the best. So that's one. Second is their complaint rate is really high. Niva Bupa has a 43 complaint rate, which is almost 2x of what the industry average is. And Care is also very high at 36. And third is their ICR, which is how much claims are they giving. It's at 58 and 59, again, not the healthiest. And so you will, and as the reason I'm covering this is because a lot of the insurance providers are going to be selling you these particular policies. I just want to make you aware that their numbers aren't the healthiest. You can take a call on your own, depending on your own affordability and your requirements. But I just wanted to call out that these two companies don't have the healthiest metrics at a company level. Now that we have the companies that we want to go after, let's now look at what are the different policies that we want to shortlist, right? The 4 factors for everybody, whether it's your parents or whether it's a policy for you, that you should look at are first, disease sublimit. Disease sublimit means a different claim limit for different diseases. So while your overall policy could be worth say 1 crore, if they say that your cancer disease has a sublimit of 10 lakh rupees, then it doesn't matter what your overall policy amount is, your claim cannot exceed 10 lakh rupees. You do not want this. You do not want your policy to have a disease sublimit. Number 2 is room rent cap, and you can see my screen here. It has all of the different definitions. Room rent cap here has one type of room only. Again, you do not want this because this is going to hamper your overall claim amount. Like for example, the policy is going to put a restriction on you that only get a single AC room. You do not want that. You want that flexibility to choose a room that you need, because at the time of an emergency, you do not want to be scrambling to look for a room within your room rent cap. And if you don't look for a room within your room rent cap, then it's going to dent your overall claim, right? So you do not want to be in that situation. So no room rent cap. Third is copay. Copay is like sharing of bill. I had said this in the previous video as well, where if you go for a dinner with a friend and if you're splitting the bill, that's copay. In this case, you have to split the hospital bill with the insurer. You do not want to be splitting the hospital bill with the insurer. So ideally, you do not want a copay in your policy. The insurance company should be paying the entire bill. That's what copay means. So no copay is what you want in your policy. And the fourth one is consumables coverage. Consumables are like PPF kit, masks, syringes, and so on. Usually they constitute for a large portion of the bill. And so you don't want your policy to not be covering consumables. A lot of the policies don't cover consumables. You want your policy to be covering consumables because this constitutes for a large proportion of your overall bill. So those are the 4 factors that we are going to look at. In addition to these 4 factors that impact all of us, there are some specific factors that I'm going to look into account for today's video, which are particularly relevant for our parents, right? The first one is waiting period, especially for pre-existing diseases. How much is the waiting period? The lower the waiting period, the better. Are there any riders we can take to reduce this waiting period? Are those riders worth it? So we're going to cover that. Number 2 is modern treatments like an angioplasty. I learned that there are certain restrictions in certain policies around angioplasty. I will walk you through those. And the third one is restoration benefit. Restoration benefit in an insurance policy is a feature which basically resets your coverage amount without having to purchase another policy. So for example, if your policy is worth 10 lakh rupees, your coverage amount is 10 lakh rupees, and you exhaust that 10 lakh rupees. If your policy has restoration benefit, it is reset to another 10 lakh rupees. And so if your bill is say 14 lakhs, 15 lakhs over the course of the year, then you do not need to buy additional insurance. It actually gets covered in the same policy. So that's what, in a nutshell, what restoration benefit means. We are going to talk about restoration benefits also in the policies that we discuss. With the criteria out of the way, let's look at the policies. And if you see my screen, these are the companies that we have from the previous tab. I've also looked at Niva, Bupa, Care and ICICI Lombard here because these are popular policies that people talk about. I'm not a big fan of ICICI Lombard because of this reason. If you look at their average claim settlement ratio over the last 3 years is at 85%, which is quite low. While their complaint ratio is good, where incurred claim, their ICR is also good and their complaint rate is also good. The average 3 years claim settlement ratio is low, and so that's why I haven't looked at it. Their other problem with their Elevate plan is that they have a single private AC room restriction, and that's why I don't have them here. So essentially, the way you want to be reading this is that the more greens these policies have, the better it is. Now, if you look at it here, the New India Assurance does not have a 1 crore cover, and it doesn't have a room rent cap of deluxe AC room here, so we don't want to look at that. The ones that we are shortlisting are HDFC Ergo, Optima Secure policy here because it's all green. Green is disease sublimit, room rent cap, copay, consumables coverage. I've also attached the policy wording here so you can look at that. I'm also going to zoom in a little bit more. The next one is Digit. Digit, the biggest problem is that there's a zone-wise copay. So if you have to go outside the zone, if you need some specialized treatment, then that becomes a problem. Similarly, consumables coverage is not there, so I'm going to not include this. Oriental Insurance has a single private AC room limit. Tata AIG has good policies, so we are going to cover them in the next shortlisted tab, and we'll go deeper into this and how do they hold up from a old person's perspective. Acko Platinum actually is not offered to old people. So I spoke to them today and they said, they didn't give me the exact reason, but they said we cannot give you Acko Platinum because this is not something that we give to a whole bunch of different criteria, but senior citizens was one of the criteria. So Acko Platinum is not there. Acko Standard is there. I will discuss that shortly. IFCO Tokyo again is a no because one doesn't have a 1 crore cover. 2, disease sublimit is there. 2, 3, room rent cap is also there. They should not exceed 1.5% of sum insured, etc. This is the family health protector policy. Next, we have the Aditya Birla policy. We will cover this in detail. It's all green. Universal Sompo I'm not covering because disease sublimit is there and consumables coverage is an optional rider separately. Bajaj Allianz I'm not covering because single private AC room is there as a room rent cap and you need an optional rider for consumables. Then we have Niva Bupa. I have already mentioned Niva Bupa. The biggest problem is actually at a company level. While their policies might be compelling, there is a problem at the company level that I think, and so I don't want to be recommending this. Care also I've discussed and ICICI also we've discussed. So now let's come to the final shortlist of our policies. I want to spend some time on these because I think there are a lot of nuances here that we should be covering. So let's start with HDFC Ergo. HDFC Ergo, like I said, it's all good here. Existing illnesses. So what is the waiting period for existing diseases like diabetes, thyroid, etc. is 3 years for HDFC Ergo. There is one good news here that at the time of renewal, you can reduce the waiting period to 1 year by taking an additional rider. It's called the ABCD chronic rider. They are offering this as a renewal benefit. So if you renew it at the end of 1 year, your policy, you add this rider and then your waiting period reduces to 1 year. So which basically means that next year onwards, you will be covered for this. So you don't need to wait the entire 3 years. This is a good benefit from a waiting period standpoint. Let's get into the premium. The premium for HDFC Ergo Optima Secure for 1 crore for your parents who are 62 and 60 years old is 1,67,675. This is a very high premium, I agree. The one feature I want to call out about HDFC Ergo is that this is actually not 1 crore, but it's a 2 crore coverage because they give you a 2x from day one. There is a 50 lakh cover if you look at that, because 50 lakh cover technically becomes a 1 crore cover. That's at 1,35,899. There is an aggregate deductible available. Aggregate deductible is a concept that I've spoken about in the past, and I think it makes sense for people who are worried about large medical bills leading to financial ruin, and they're okay if it's a small bill of say 3 to 5 lakhs and they can afford that comfortably, they do not need that. Then you can take an aggregate deductible. Aggregate deductible essentially means that over the course of the year, all your bills, if they add up to the sum of the aggregate deductible, then the policy will kick in after that. So for example, your policy is worth 1 crore with an aggregate deductible of 5 lakh rupees. The first 5 lakh rupees, not on one bill, but across all bills, will not be covered. Once you hit that 5 lakh rupees, then after, and you cross that, that's when your policy starts to cover it. So that's what aggregate deductible means. The biggest advantage of an aggregate deductible is that it reduces your insurance premium. So aggregate deductible, there are 3 options: 1 lakh, 2 lakh, 5 lakhs. If you have a 1 lakh aggregate deductible, your policy amount goes down to 81,540. 2 lakh 74,000 and 3 lakh is 51,650 and 5 lakh is 51,642. The way to get this done is that if you actually go to the HDFC Ergo website, this is how you see these options at the time of checkout, where you can select any of these aggregate deductibles and get these discounts as you are availing them, right? So aggregate deductible is a nifty feature that you can use to reduce your premium and get probably the best policy out there. Some of the other features that I want to call out about HDFC Ergo, which I found useful, I've already said that this has a 2x cover from day one, unlimited claims twice during the policy terms. Number, there's unlimited restorage here, so you can keep restoring. It's unlimited, which is again amazing from a restoration standpoint. The ABCD chronic rider, which has been introduced, which means at the end of the first year, when you can reduce your waiting period from 3 years to 1 year by taking the additional rider. So it's very, very useful for parents who might have any pre-existing diseases. Fourth is the claim settlement time. The average claim settlement time around the industry is 2 hours. ICICI says 2 hours. Acko says 1 to 2 hours. HDFC says approval time of 20 to 38 minutes. They are that specific about it. It's on their website. So if they're so confident that it's 20 to 38 minutes, seems like a pretty robust claim. So you should, and I've heard from people that this is quite a painful hassle, getting their money approved, especially in the case of cashless. So this is a good feature. 20 to 38 minutes is what they claim that they're going to approve your cashless reimbursement in. The other one is heart attack, robotic surgery, angioplasty, all that is covered, all modern treatments are covered. I'm talking about modern treatments because there is actually one policy that we'll cover later, where there is like a lot of clauses around modern treatment, and I want to shine some light on that. OPD is excluded. There is an add-on available for OPD in case you want that. Cancer, heart attack, all of that is included. Slow-growing illnesses like cataract, hernia will be covered after 2 years. So that's something that you need to keep in mind. I was told this because remember I had said that there's cataract, but because my father's already gotten his cataract done, we are okay even if these are covered after 2 years, because once they are done, you don't really see the need of this coming up again. So that's on the HDFC Ergo. Okay, next, after HDFC Ergo, let's get into Tata AIG. Tata AIG is pulling out, making some good products. They have two policies that are shortlisted. One is the Tata Medicare Premier and the other is the Tata Medicare Plus. Now, the key difference between Medicare Premier and Medicare Plus is on waiting period. Medicare Premier has a waiting period of 2 years for pre-existing conditions, whereas Medicare Plus has a 3-year waiting period. Because it's parents, there might be a high chance that there must be some pre-existing decisions, and therefore I think this is an important point to call out. The second big difference between Medicare Premier and Medicare Plus is that Medicare Premier has a 3 lakh rupee built-in deductible. So there is, when you go to buy this, you have to, in a 1 crore policy, the first 3 lakhs are not going to be covered. It is a built-in deductible. Whereas in Medicare Premier, you can have zero deductible if you want. And therefore the premium is much higher. And the third large difference is that Premier covers bariatric and maternity, whereas Plus does not cover bariatric and maternity. I think these are features that are not needed for parents, so anyway it doesn't matter. So I think where I'm netting out in this is that if you're okay with the longer waiting period of 3 years, if you're okay with the 3 lakh deductible, then Medicare Plus might not be a bad policy for you to consider. It is also significantly cheaper than the Medicare Premier. The premium amount for 1 crore for Medicare Plus is at 61,134 with a 3 lakh built-in deductible, whereas the same policy on Medicare Premier without a deductible is for 1,51,000, so almost 90,000 rupees more expensive. For a 50 lakh cover, you get 56,000. You pay 56,000 for Medicare Plus. Here, the deductible is 2 lakh rupees. Built-in deductible is 2 lakh rupees, and for 50 lakh cover, it's at 1,07,394. So that's where we are at from a Tata AIG standpoint. I think both of these policies are pretty good and I would recommend them. Let's jump to Acko. Acko, like I was saying earlier, Acko Platinum is not being offered. When I spoke to the Acko team, they said that there are a whole bunch of reasons why we can't offer you Acko Platinum. We can't pinpoint which one is it, but my guess and my hypothesis is that it's because senior citizens and there is a chance of having pre-existing diseases. The key value proposition of Acko Platinum is a no waiting period, and that's why they're not offering Acko Platinum. The next policy that they offer is Acko Standard. I think it's not a bad policy. At a high level, it's a decent policy, covers everything that you need. Has a disease sublimit, room rent cap, copay consumables, everything's covered on Acko. So I think it's not a bad thing. The other thing from a waiting period standpoint, what I want to call out is it has a 3-year waiting period for pre-existing conditions similar to HDFC Ergo. They have a chronic rider, which basically means that from day one, your chronic diseases like an asthma, cholesterol, blood pressure, diabetes will be covered. I asked them for what the cost of this rider would be. So they said that for a 1 crore policy, it will be anywhere between 20 to 25,000 rupees for the cost of the rider. So it is a rider which is available for those chronic diseases to be covered from day one. I think it's a good one for parents to have in case any of your parents have that chronic disease issue. Then you can actually get that covered under this Acko Standard from day one. How much is the premium for 1 crore rupees? Very cheap. Acko's value proposition is around cheap. 54,159 is the premium amount for a 1 crore cover. For a 50 lakh cover, it's only 200 rupees cheaper, 53,981. And for a 25 lakh cover, it's again 1,000 rupees cheaper or something. So basically, they're incentivizing you to buy the 1 crore plan because the price difference between a 1 crore plan and a 50 lakh plan and a 25 lakh plan is negligible. It's 200 to 1,000 rupees, right? So I would say that just buy the 1 crore plan if you're looking for Acko Standard. If you add that ABCD chronic disease rider, add about 20 to 25,000 to this, so it will come to about 75 to 80,000 rupees for a 1 crore cover, which is not bad at all. And no aggregate deductible here, so it's actually among HDFC Ergo, Tata AIG, and Acko. Acko is the most cost effective. No surprises there, right? It's a new company, they're trying to grab share. It'll be interesting to see how this plays out over the next couple of years. As you're renewing your premium, are they going to be increasing the premiums more aggressively than other companies? We don't know, but it's a hypothesis that I have that they might actually do that going forward. So that's on Acko. Overall, good policy. Finally, last but not the least, let's cover Aditya Birla policies. From a company and from a policy standpoint, they were decent in terms of the numbers. There are two policies here, Activ One and Activ One NXT. Activ One is also known as Activ One Max sometimes. Its naming is really confusing. But essentially what Activ One, let's start with Activ One NXT first. Activ One NXT has a copay clause of 20%. So this is out. We are not going to be covering this. The other one is Activ One, which has basically checks all the boxes. No disease sublimit, no room rent cap, no copay, and covers consumables. So all good. Existing illnesses has 3 years, which is similar to what HDFC Ergo Optima Secure does. This is a policy which is very similar to HDFC Optima Secure because one, it has a pre-existing disease of 3 years. The second thing that they have is also the 2x coverage from day one. So if you're buying a 50 lakh cover, you're actually getting a 1 crore coverage from day one, right? So that's very similar to what Optima Secure does. How much is the premium? The premium is 1,16,825 for a 1 crore cover and 91,007 for a 50 lakh cover. The one good thing here is that there's actually a rider. If any of your parents have an existing disease and you want to reduce the waiting period, these guys have a rider which reduces the waiting period for existing illnesses from 3 years to 1 year, and that rider costs 22,000 rupees. So this 91,000 for the 50 lakh cover, this 91,000 goes up to 1,13,759 if you buy that rider to reduce the waiting period for your disease from 3 year to 1 year. So for all of you who are looking for a policy for your parents with a pre-existing disease, this might not be a bad thing. Overall, I think this is a decent policy you can consider. One thing that I did not like about Activ One, I want to call out from their document is that they've gone into like really detail. So if you look at their policy document and compare it to any of the other policy documents, they've gone into too much depth in calling out what the exclusions are, and I don't necessarily find them very comforting. What do I mean? So this is one section there, cancer of specified severity. They are saying that if you have any of these cancers, we are not going to offer you the policy. That is one thing. The second thing they are saying is that less than stage 3 cancer is covered in your policy, but higher than that is not covered. Right? So again, this doesn't make me very comfortable because nobody else has mentioned this per se. They are covering, I would assume that if it's not mentioned as an exclusion, they will cover it. But these guys have mentioned it as an exclusion. So that's on cancer. The second thing that I did not like here is these two clauses, open heart replacement or repair of heart walls. What I want to point your attention to is this last line, catheter-based techniques including but not limited to balloon valvotomy, valvuloplasty are excluded. Again, no other policy is calling this out. These guys are calling it out, which makes me uncomfortable. Also, look at the language, but not limited to. This is almost like that they are covering their ass, that if tomorrow we get a claim which is out of the ordinary, we are going to use a clause like this to wiggle out of that claim, right? Therefore, I don't entirely trust Aditya Birla because of these clauses that they put in here. The last one is also this open chest CABG. Now here, this is following are excluded angioplasty and or other intra-arterial procedures. I really dug deep into this to understand what do you mean by angioplasty is excluded, because this is a pretty common, like if you have a heart issue, this is a plausible outcome. They said that if it's an open heart surgery, angioplasty is excluded. If it's not an open heart surgery, then angioplasty is included. I am no doctor. I am no cardiac expert. If any of you are there out there, tell me if this sounds reasonable to you, if this makes sense to you, because I don't understand it. The fact that they've mentioned it makes me uncomfortable because nobody else has mentioned it. And so I've assumed a blanket approval there for any heart diseases, cancers, and so on. The fact that these guys have gone to these depths to actually mention and call these exclusions out is not landing well with me. And the last one here is surgical treatment for benign brain tumor. Again, a lot of the stuff here that they've called out is that we will be covering surgical treatment limited to all of these things. So again, limited to, right? The language that they've used is it is limited to only these things. If there's something beyond this, then we're not going to be covering it. So a lot of clauses, subtext that Aditya Birla policy wording has, which others don't, and therefore that's a slight risk that you run that you should be comfortable with. So with that, we've come to the end of this video. Hope you found that useful for your parents as you're thinking of buying them a policy. All the resources are going to be on my Substack, so just go subscribe there and I will send it to you as usual. If I had to choose between these, I think Tata and HDFC seem to be good policies. Aditya Birla is not a bad policy on paper, but these sub-clauses make me a little uncomfortable. Acko Standard is also a decent policy, so I don't think you can go wrong with either of these. But I would love for people to share comments about their experiences with these policies so that others can make a more informed decision. Thank you and see you in the next one. Keep your comments coming about what are the different types of videos that you want me to cover. As you can see, I see those comments and make videos and hopefully you found value in them. So thank you. See you in the next one. Bye-bye.